Welcome to the first episode in a brand new monthly series on all things superannuation with our SMSF guru, Alan.
Thanks, Steph. Welcome, everyone. I think the first video that we should do is a follow-up from the budget announcements announced last May that have now been enacted into law.
There seems like there's been a massive amount of change over the last 6 months in the superannuation arena. We're certainly getting a lot of questions from people asking how it's going to affect them and what's actually likely to happen. So as the guru, what's actually changing? Let's start with what's happening in terms of contributions. How much am I going to be able to contribute to super from the 1st of July?
Okay, from the 1st of July, everyone's going to be going back to $25,000 a year. That changes from the current, as until the 30th of June this year. If you're over 50, you can put 35,000 in. And if you're under 50, then you can put 30,000 in. So there's a reduction across the line there.
So that's a big reduction. If you're over 50, that's $10,000 less you're going to be able. Wow. Okay. So that's if I'm putting it in as an employer, so basically being an employee and contributing money to super as a tax deductible contribution.
Correct.
What if I just want to put in some personal contributions?
Okay, so anyone that's looking to put in personal contributions can currently put in $180,000 per year or $540,000 if you'd like to bring forward a 3-year contribution cap. That's actually changing from the 1st of July as well, so that it'll be reduced from $180,000 back to $100,000 per person per year. However, there's this magic number in superannuation of 1.6 million. If you have a balance of over 1.6 million as at the 30th of June this year across all your superannuation policies, then you'll no longer be able to make any non-concessional contributions into super.
Okay, so that means if I've got $1.6 million as me, as a person in super, I'm not going to be able to put any contributions into super other than the ones that my employer or me as the business owner, as my employer, has to put in.
That's correct.
Okay, so really, the 30th of June is going to be a magical time. That's right. And we've got 6 months to get some things cracking. Okay. One of the questions that I always get asked is, why would you want to contribute more to super anyway?
Okay, super is currently one of the most tax effective ways to save money in Australia. So as an employee, you can actually reduce your tax on any savings that you have from your wage down to 15% on your contributions, as opposed to your marginal rate, which could be anywhere up to 47 cents in the dollar. So you've got to think about that year on year. That's a saving of 30% on that money every year while ever you keep working.
It's a lot of money, isn't it? And what about the personal contributions? If I'm going to put those into super, why would I decide I want to do that?
It's still the same reason. Tax is still a big saving for people. If you think about the earnings that you've got on that money, if you have it outside superannuation, that's again taxed at your personal rate. So that could be 47% for people that are lucky enough to earn a lot of money, or even people that are still working, you're still being taxed at anywhere in the 30-cent dollar range. So those earnings inside superannuation are only taxed at 15%, which means you're saving at least 15% year on year throughout the entire time that money's inside superannuation. So it's still worthwhile.
Certainly looking at as part of your overall strategy. So stick with the people who are earning a lot of money. What's happening for people who earn more than $250,000 of taxable income in a year?
Okay, so currently there's a rule of 300,000 that if you earn more than that, your superannuation contributions that come in from your employer are taxed at 30% instead of 15%. The government, because they love collecting revenue, have reduced that from 300,000 back to 250,000. So anyone earning over that is going to also have their superannuation taxed at 30 cents in the dollar.
Okay, that's a large decrease, certainly a huge decrease, and a big tax hike to basically be taxed double what you would normally be taxed on super as well. Okay, what's happening for people that have retired?
Okay, so for people that have retired, the 1.6 million is coming into play again. So if you have more than $1.6 million in super, then the earnings on that will be taxed at 15 cents in the dollar above the $1.6 million.
Okay, so there's obviously this magical number that's now $1.6 million for everyone. Oh dear, what are we going to have to do before the 30th of June? And I just want to clarify with that, it's $1.6 million per person or overall?
That's right, it's per person. So for a husband and wife that are looking at retirement, you're still going to be able to have $3.2 million inside superannuation in a tax-free earnings environment. So it's not completely bad news. It just means for people that are lucky enough to have more than $3.2 million, they're going to start paying some tax on the earnings inside their super. For those people that are ranged between 60 and 65, now's the time to be looking at planning your contributions really carefully to make sure that if someone's closer to 1.6 and the other person isn't, is it a time now to put some of those contributions in the other person's name so that you've got a relatively even balance by the time you stop contributing?
So I heard loads of fun between now and the 30th of June to make sure that everyone is kind of increasing the right person's balance and really thinking about what that $1.6 million is going to mean to them if they're nearing retirement age. So there's also been a change for people who are transitioning to retirement as well. What's happening there?
Okay, so one of the key benefits of starting what we call a transition to retirement pension, which is where you're still actually contributing to super, but also taking out money from your superannuation. The tax savings were twofold in there. You not only have tax-free pension coming out to you if you're over 60, you'd also have tax-free earnings on that superannuation balance that you keep contributing to. Unfortunately, the government has actually going to remove the tax-free earnings on that pension amount while ever you're still contributing to super.
So I'll go from paying zero tax on those earnings to paying 15%, which is still much lower than what I would normally be paying if I'm still working anyway.
That's right.
But I will have to be paying tax. And what's changed for people who are actually over 65 and working? There was talk they were going to bring in a new rule. Is that still happening?
On the budget night, they were looking at removing any works tests that you had to be able to make contributions. So currently, you need to have worked 40 hours in a 30-day period to be able to make contributions after age 65. There was talk about that being removed, however, it's still in play. So anyone over 65 that's looking to contribute those non-concessional amounts into super will have to still pass that works test to be able to do it.
All right, which is not too hard when you think about 30 days, basically a month, and having to work those 40 hours.
That's right. It works out to be a week in the month.
Perfect. So the big change, though, seems to have been around the aged pension.
That's right. And it's the big change with the government, and they announced this 2 years ago now, is that to qualify for the age pension, before you cut out, you were able to have assets of up to $1.1 million. That's now currently being reduced to $800,000, and it's affecting 300,000 Australians. So it's a massive change, and people will be getting letters in the mail now in order to be still qualifying for the age pension.
Okay, so there's going to be a lot of work done in January because that comes into effect now, I believe, not in July?
Now.
Okay, so there's a lot of work to be done in January as the 300,000 Australians
gets closer.
Either lose their pension completely or have it reduced.
That's right.
Wow, okay, so that is really, really big. All right, so we know that there's this magical number of $1.6 million now, and we're not going to be able to put any extra money into super, personal money into super, if we've got more than $1.6 million. What's happening if you are a retired person who's taking a pension who has more than $1.6 million personally, so for themselves, inside super? Okay,
for those people that have more than $1.6 million, you'll still have the earnings on your pension up to that $1.6 million tax-free. It's only going to be the excess. So let's just say someone's got a $2 million pension balance inside their superannuation. The $1.6 million of earnings will be tax-free. It's only going to have tax on the earnings on the difference of $400,000 at 15%.
Okay. What happens though with selling of assets? Because At the moment, if I've got a building, let's say, and I purchased the building 10 years ago and it's grown $300,000 in value, and I sell that and it's part of my pension asset, at the moment I don't pay any tax on that capital gain. What will happen if I've now got more than $1.6 million inside my pension account and I sell that asset?
Okay, it means that partial amount of that gain will be taxable to the fund. So for capital gains inside superannuation, the effective tax rate of a capital gain when you are paying tax is only 10%. So it's only going to have a small amount of tax, but for some people it won't be tax-free. You'll be paying tax on it.
So not the worst case in the world being taxed at 10%, but still a consideration that definitely needs to be made.
Correct.
Okay, so we're both young. Well, I like to think that we're young spring chickens. What's actually changing for us, and what do we need to do before the 30th of June? Is there anything really changing for young people?
Okay, well, we've got the 1.6 million that we're working towards now, and that doesn't just affect young, it affects everyone. But coupling that with the reduction in the contributions back to $25,000 from your employer, we basically need to start that planning process a lot sooner and keep an eye on your superannuation right now. It might not mean you'll be able to do something straight away, but that planning and taking control of your personal wealth empire needs to really start now.
Perfect. And definitely with those contributions being reduced is a huge, huge issue. So there's also a new rule that's coming in on the 1st of July 2018, I believe, something about catch-up contributions, just to confuse everybody as well.
Yeah, so not this next year coming, but the year after. The government's allowing people that have basically not contribute up to their maximum $25,000 to be able to play catch-ups. So if we're saying looking at the 2020 tax year, we're going to be able, and I've only put $10,000 worth of concessional contributions in the 19 year, I'll be able to put in not only the $25,000 for the 2020 year, but also the $15,000 that I didn't make the year before into superannuation to be able to catch up.
Which is quite good, and that's happening for 5 years, is that correct?
That's happening for 5 years, but you can only do it wherever your superannuation balance is under $500,000.
Okay, which I imagine for a lot of, say, under 40-year-olds potentially may be at that level.
Yeah, it will affect most people our age.
Our age, I like that. Okay, what about people who are thinking about retiring or kind of that 5 or 10 years away from retiring? What do these changes actually mean for them?
Okay, so the 1.6 million is definitely coming into play when you're in that approaching retirement phase, because the balancing of your super is incredibly important here. If you've got, and this is the time when most people have the most amount of money to be able to put into superannuation, you need to be really careful and clever about the way you're putting money into superannuation so that you've got the most amount of money that you possibly can tax-free for when you decide to stop working and retire.
Which hopefully for those people less than 5 or 10 years away.
That's right.
Okay, so what's changing for people who've actually retired and might be taking a pension? Did they need to do anything before the 30th of June?
Okay, anyone that's retired and not contributing to their fund anymore doesn't need to do anything. For those lucky few that have the balances over 1.6 million, there'll be the tax adjustment that we need to do for them behind the scenes, but otherwise there's not many changes that will affect you other than that in the age pension.
Okay, so if I've got my own self-managed super fund, which obviously most people watching this have their own self-managed super fund, I don't need to do anything. You will take care of all of the wonderful paperwork and administration that needs to be done behind the scenes.
That's exactly right.
That sounds fantastic. But my opportunity is, I guess, if I'm a young person or if I'm still contributing, that before 30th of June is the opportunity for me to get the most amount of superannuation in, as opposed to waiting until the 1st of July. So just to recap, make sure I've got this right. If I'm over 50 50 or over,
Yes.
I can now contribute $35,000 for this financial year only.
Correct.
So I really need to get my skates on and get that money in before the 30th of June.
That's right.
And if I'm under 50, I can contribute up to $30,000. So again, skates on and get that in before the 30th of June. And if I'm thinking about putting a personal contribution in, I should definitely do that before the 30th of June, because
Correct.
I can put $540,000 in this year,
Correct.
and I can only put $300,000 in
From next
year.
onwards.
One of the questions, or one of the things that we often look at for people with superannuation, is why you would put that extra money in personally to super. And I know certainly for a lot of young people who are looking to purchase buildings or their business premise inside their super fund, they occasionally don't have enough to purchase the entire property, but likewise they don't have enough outside of super to be able to purchase the property either. It's going to make a huge difference on the 1st of July if you needed to put in $330,000 into your super fund to purchase the big building, as opposed to, now you could do that. Come the 1st of July, you're not going to be able to. So what do you suggest people do in their planning and thinking in the next 6 months before 30 June?
For the next 6 months, you really need to do exactly what you said and plan what your future plans are with buying assets, because as we've already discussed today, superannuation is still a really low taxed environment and quite often the best vehicle for you to be able to own assets. So if you are thinking about potentially purchasing that building, you've got that 6 months now to really put in as much as you can in superannuation, because as of the 1st of July, when those limits come in, that's going to be severely reduced. And it could be the difference between you buying that property that you're looking at inside super or having to buy it outside super.
Where you potentially may not be able to, and then building the dream empire may not happen, and that would be an absolute tragedy.
That's right. We don't want that.
We don't want that. Wonderful. Okay, so there's a lot of changes, and obviously we've just skimmed over the main and big ones that are actually happening. If anyone has questions, they should definitely get in touch with you, I'm assuming.
Give me a call, shoot me an email.
And you can answer all of their hard questions at the same time.
Can do.
And we'll be back next month to talk about building your entire empire, which is looking at your super, your business, and your personal assets as well.
Excellent.
Thanks, Alan.
Thanks, Steph.